After the AI frenzy, markets turn their focus back to the Federal Reserve. I'm Lisa Bernhard with Reuters, and I'm joined today by Kevin Mahn. He's President and Chief Investment Officer at Hennion and Walsh Asset Management. All right, Kevin, stocks have been wavering today, and it appears that because we're just a couple of days ahead of some key inflation data, the personal consumption expenditures report, that all eyes are back on the Federal Reserve. Of course, this is a key piece of information when it comes to when they'll cut rates. What do you think we will see in this report?
In all likelihood, we're going to see similar results to what we saw out of both CPI and PPI, and that is that inflation remains elevated, which once again reminds us all that the Fed has a very difficult job. Is going to have to really thread the needle to help balance out bringing inflation closer to their 2% target and also helping to avoid their own forecasted economic recession, or rather slowdown from becoming an economic recession.
So, Kevin, for a long time, advisors like yourself have been saying to me that the Fed's annual target rate of 2% inflation is really their aim. And if the economy falls into a recession, so be it. Is that still the Fed's thinking?
I believe that the Fed is a lot more comfortable with inflation above 2% than they are with the economy moving into a recessionary period. And I look to their most recent summary of economic projections to help validate that thought process. Consider this. Over the next 3 years, the Fed is forecasting to cut short-term interest rates by 250 basis points, 75 basis points this year, and 325 basis point cuts likely during the second half of the year, another 100 basis points in interest rate cuts in 2025, and yet another 75 basis points in 2026. Yet all the while, they don't forecast inflation coming back to their 2% target until the end of 2026. They believe it's going to finish this year somewhere between 2.4 and 2.6%. So that tells me they're much more comfortable with inflation staying above 2%, albeit below 3% as well, than they are with their own forecasted economic slowdown dipping into a recessionary period. Otherwise, they wouldn't be considering cutting interest rates.
So markets have appeared to have largely priced in a soft landing. But what are these signs that the economy could still fall into a recession?
Sure. I believe that the market has priced in a perfect execution of a soft landing, and that certainly is not a given. I believe there stands the likelihood of either a return of inflation or a recessionary period. Consider this. The Federal Reserve is forecasting real GDP growth this year to slow to 1.4% from 3.3% last year. They're also forecasting economic growth to stay below 2% all the way through the end of 2026. So it's going to be very difficult to achieve that soft landing if they have to worry about stimulating the economy at the same time inflationary pressures exist. So I believe in all likelihood they need to see at least 2 consecutive quarters of an economic slowdown before they feel comfortable cutting interest rates, or they fear what happened back in the late 1970s when they cut interest rates prior to getting back to their 2% target. And what happened? Inflation returned. We had double-digit levels of inflation. Then Chair of the Federal Reserve, Paul Volcker, stepped in, raised interest rates to as high as 20% on the Fed funds target rate. That killed inflation, but it also brought on an economic recession. I don't envy the job of the Federal Reserve, but I do not believe that a soft landing is all but guaranteed at this point in time.
I said that investors had turned their attention away from the AI frenzy, but I don't think they can ever really turn their attention away from the AI frenzy. Do you think that NVIDIA, when it comes to profits, is really the only game in town, as some investors have told me, or do you have your eyes on other companies? What do you think?
Certainly, AI has been the tail that's been wagging the stock market dog for the better part of the last year. And NVIDIA, the poster child for AI, if you will, did a lot of wagging last week with their third consecutive quarter of blowout revenues and blowout earnings and forward-looking guidance, remembering that their ultimate delivery of their new next generation chip, the B100, isn't scheduled until later this year. So that should only provide more momentum for revenues and earnings growth. But to your question, I do not believe that NVIDIA is the only game in town. And I believe investors would be wise to consider the entire ecosystem that surrounds artificial intelligence is going to help them to continue to evolve. Those areas include hardware, software, and even the data center, in addition to the semiconductors and the chips. Look for those companies that have demonstrated experience in these areas, the balance sheet strengths to help be able to withstand an economic slowdown, and the expertise to navigate the potholes that are likely ahead in the overall AI race.